Good day, ladies and gentlemen. Welcome to the Enablance Technology Financial Results Conference Call. The presentation of the information on this call may contain forward-looking statements that are made as of the date hereof and are based on current expectations, forecasts, and assumptions which involve risks and uncertainties associated with our business and economic environment in which the business operates. These risks and uncertainties include, but are not limited to, the divestiture of the systems segment, pricing competition, dependency on new product development, reliance on major customers, customer demand for our products and services, control of costs and expenses, international growth, general industry and market condition and growth rates, and general domestic and international economic conditions including interest rates and currency exchange rate fluctuations. All such statements are made pursuant of the safe harbor provision of and are intended to be forward-looking statements under applicable Canadian securities legislation. Any statements made during this call that are statements of historical facts may be deemed to be forward-looking statements. For example, the words anticipate, believe, plan, estimate, expect, intend, should, may, could, objective, and similar expressions are intended to be identified forward-looking statements. By their nature, forward-looking statements require us to make assumptions and are subject to inherent risk and uncertainties. We caution our listeners on this call not to place undue reliance on our forward-looking statements as a number of factors could cause actual results, conditions, actions, or events to differ materially from current expectations. Enablance does not intend and disclaims any obligation, except as required by law, to update or revise any forward-looking statements, whether as a result of new information, future events, or otherwise. I would now like to turn the meeting over to Mr. Tim Thorsteinson. Please go ahead.
Thank you, Operator, and welcome to the Enablance Second Quarter Fiscal 2012 Financial Results Call. I will have Dave Tays, our CFO, update you on the results of the quarter, and I'll give you an update on the business, including the status of our China joint venture and the status of the sale of Teledata. Dave, over to you.
Thanks. First, as a reminder, last quarter we adopted IFRS and changed our presentation currency from Canadian dollars to U.S. dollars. These changes have been reflected in our financial results for the current and prior year. These impacts are described in more detail on Note 18 of the financial statements filed yesterday on SEDAR. As a reminder, we've reclassified the operating results from the systems segment, including Teledata, into discontinued operations. The financial information that I will focus on is that of our continuing business, which is focused in one segment, optical components and subsystems. Revenue for the current quarter was $3.6 million compared to $8.7 million in the prior year, a decrease of 59%. We continue to see a drop in customer demand, which we first saw during our June quarter when compared to the prior year. The revenue decline is mostly in our AWG and VMUX product lines. We expect revenue for the March quarter will be similar to that of the December quarter. We believe the end markets will improve for our photodiode, engineering services, and optical components offerings. However, the timing of this is difficult to predict. We are focused on bringing new products to market to improve revenue independent of a market recovery. Tim will speak to this later in his call. Gross margin for the current quarter was 3% compared to 33% in the prior year quarter. The decrease was primarily due to decreased volumes as we spread our fixed costs over a smaller revenue base, as well as increased pricing pressure we're seeing in the market. And these negative impacts were partially offset by the cost reductions achieved from our consolidation of U.S. operations in Fremont, California. Operating expenses, comprised of research and development, sales and marketing, and general and administrative costs, were down almost $900,000 compared to the prior year quarter at $2.6 million in total. This decrease was mostly in general and admin due to the end of certain consulting agreements and the consolidation of U.S. offices. Marketing expenses are also down as we reduced marketing costs at the end of calendar 2010. Adjusted EBITDA, a non-GAAP measure we use to measure the ongoing operations of the business, was a loss of $2.1 million in the current quarter as compared to a loss of $200,000 in the prior year quarter. Adjusted EBITDA removes the impacts of non-cash and non-operating related elements. The decline in adjusted EBITDA was driven by the decrease in revenue compared to the prior year, partially offset by the savings from the operations consolidation and G&A. For the current quarter, our loss from discontinued operations was $400,000 compared to a $4.3 million loss in the prior year quarter. As you'll recall, we completed the sale of most of the U.S. systems business in the September quarter, and that, combined with the reduced amortization and continued cost reduction, increased the losses incurred in that business. Let me shift now to discussing our cash position. At December 31st, we had cash balance of $7.3 million, including $2.4 million held in discontinued operations, compared to $11.9 million at June 30th, 2011, our year-end, including $1.5 million held in discontinued operations. The decrease in cash in continuing operations of $5 million from June 30th was primarily due to the negative EBITDA combined with debt service costs incurred. We currently have $6.5 million of cash, including $3 million held in discontinued operations. We have $13.7 million of notes payable and current liabilities based on the current terms for our notes. We've started discussions with certain note holders to renegotiate the terms of these notes, and we've also initiated discussions to obtain additional financing in order to support the business through its transition to more complex and differentiated products. We're exploring several options that we believe will drive a successful result. I'll now turn the call back over to Tim.
Thanks, Dave. Enablance is at the front end of a significant transition. We are transitioning our company from a business focused primarily on AWG and BMUX products to a much broader portfolio with more proprietary products, many of them coming from our design center in Ottawa. We have completed our first significant project to design 100 gig components and are moving to the design phase, from the design phase to the production phase, a process that we expect to complete by June of this year. We expect a minimum of $5 million of revenue from this space in the next 12 months, with an opportunity to grow far beyond this as we're selling to some rather large customers. These components put Enablance into the TOSA-ROSA space. I'll say a little bit about what that is. Transmitter optical subassembly and receiver optical subassembly, TOSA-ROSA space, a new market for Enablance, and one that we believe we can leverage with our joint venture to drive significant growth. We have 5 active product development efforts focused on the TOSA-ROSA space, many of them going into production over the next several quarters. We have started shipping our multicast switch and expect that it will generate over $1 million in additional revenue annually moving forward. We are expanding our Zurich-based photodiode product line to include higher speeds avalanche photodiodes and are introducing packaged photodiodes at the OFC show next week in Los Angeles, which will expand our available customer base. We'll show our first release packaged photodiode products at the trade show I mentioned. We are producing low volumes of splitters in our joint venture with Sunsei Telecommunications in Foshan City, China, and are working through the processes to improve yields and quality to full production in the coming months. We are not planning a significant short-term recovery in our core AWG and BMUX business, but rather are focused on leveraging our planar lightwave circuitry technology into new and differentiated products that will address the growing need for faster and more flexible networks. These product introductions will allow us to grow without a significant market recovery. As I have been saying for several quarters, possibly the most exciting opportunity we have continues to be our joint venture with Sunsei Telecommunications in China. I have just returned from a trip to China last week and will provide an update on the status of the Chinese JV. The joint venture gives us access to low-cost manufacturing in China and a platform to aggressively enter the rapidly growing Chinese market for optical components. We can then leverage that market participation into other markets in the world. Our partner, Sunsei, is growing over 40%, with a large and growing list of top-tier customers worldwide. In September, the joint venture completed the build-out of its facility in Foshan City, China, and in December, it completed the installation of the majority of the equipment needed to produce the splitter chips that are the basis for the JV. While we had expected the JV to get its first wafer off the line in December, there were some delays due to unforeseen challenges in bringing certain parts and chemicals required for the fabrication process into China. This venture is probably, no doubt the most sophisticated splitter plant in the Far East. These challenges have been overcome, and the JV is now producing its first wafers. I saw some of them last week. The JV is focused on improving its processes and training the first 62 employees it has on board to bring quality and yields of splitter chips to the level needed to meet the significant customer demand for this product. The JV and Sunsei, our JV partner, are actively seeking additional customers for this splitter capacity, and we are targeting to be the leader in this market within 2 years. The JV is currently producing first-runner pilot wafers and begins an aggressive production ramp in April. Our target is to be producing at a rate of over 1 million splitters a year by the end of our calendar year in the next 9 months. While the JV could possibly generate some revenue in this quarter, it won't be material. We expect the revenue to start a significant ramp in April. While the initial focus of the JV is splitters, we're starting to plan capacity to produce our Tosa Rosa products in the JV also, and we believe that our JV partner Sunsei will open further access for our Tosa Rosas in the Chinese market. In its first 12 months of operation, we continue to expect the joint venture to generate revenues of $8 to $10 million and to be profitable. With significant growth after that, we will reflect 49% of these in our numbers. We expect the JV to be accretive to our adjusted EBITDA within the first year of operations. We're extremely excited about the progress to date and the prospects for this business. I believe it will generate significant shareholder value over the next year. Finally, I'd like to provide an update on the status of our divestiture of Teledata. The good news is that the business has been operating on a cash neutral basis pretty much since we announced we were going to divest of it. So we haven't had to put any additional cash into the business. As of today, while we have not completed the sale of the Teledata business, we continue to explore all strategic alternatives and are active with several potential buyers for the most value-enhancing divestiture. We continue to have active discussions. However, the sale continues to be complex. While we were targeting a definitive decision by the end of December, we have not been successful to this point. We do believe we're close to a final resolution, and the timing continues to be difficult to predict. To summarize, in the very near term, we're focused on the divestiture of Teledata, securing near-term financing to manage through our product transition, the refinancing of our notes payable. We believe we have a solid product strategy to grow in the optical components market and are excited about the opportunity we have to be a market leader in China through our Chinese joint venture. At this time, I'll turn it back to the operator and take any questions that you might have.
Thank you. We will now take questions from the telephone line. If you have a question, please press *1 on your telephone keypad. You may cancel your question by pressing the # sign. Please press *1 at this time if you have a question. There will be a brief pause while participants register. We thank you for your patience. Our first question is from Daniel Kim of Paradigm Capital. Please go ahead.
Morning. Thank you. Tim, I want to go back to one of your comments on the JV. You suggested that you've already started producing first wafers. The MD&A suggested, I believe, that you will go into volume production towards the end of March, April timeframe. So am I reading correctly here in terms of volume production versus, say, first revenues? Do these wafers now just require packaging before you see some revenues come
There's actually, just a point of clarification, we're selling the splitter wafers at this point. We're not going to be in the package splitter business. So what we're going to be doing is creating splitters from 1x4 to 1/64. We're going to be selling them to customers who are then going to package them into full splitters. We haven't made the decision yet whether or not to third parties other than Sunsei we're going to sell full splitters or just splitter chips. We haven't really made that strategic decision yet. So what I saw in Foshan City last week was wafers with, fully operational splitters on them, right? The issue at this point is we're coming up the yield curve. We have targets for the yield in terms of the volumes we want to get through the factory, and we're slowly marching up that path. So we may ship some wafers to Sunsei in March and take some revenue. We have an aggressive production ramp that starts in April, and it goes, tens of wafers a week, and we get, it's proprietary, but we get a lot of splitters off every wafer, and then, by the end of the year, the October, November, December time frame, we're at 80% of the current installed capacity. So it's a steady ramp. It is measured and rational, and I am hopeful we can accelerate it. But it's all very analytical. And we had a board member with us on the trip. It's an extremely complex process, which the good news there is that the barriers to entry would be rather high. We have $20 million of production equipment in the factory at this point. It's all brand new. It's a beautiful factory, but we've had to train all the employees and get them up to speed and, get in all the gases and get all the processes going. Our big value in the joint venture is our know-how and our ability to actually build splitters from the old A&D Devices business. So we'll begin a significant production ramp in April.
Okay. Can you clarify, Tim? I think I missed your commentary. Did you say you're going to be exiting 2012 at 1 million splitter run rate per year?
It will be significantly in excess of that.
As an exit run rate or a total volume for 2012?
That'll be that'll be taking how many splitters we're planning on producing in December and multiplying times 12. But it'll be somewhere between 1 and 2 million.
Okay. And you anticipate you'll hit 80% of capacity by
well, the current and we do have more floor space. So the capacity is related to the CBD equipment, and we've got 3 of the 5 pieces of equipment up and operational. We may have more installed capacity by then, and we could certainly add capacity because we do have more floor space. So we'll be getting up to the current installed capacity, and that's again, largely dependent on yields. It's obviously a lot different at 90% yield than 70, so there's some factors in there. But the good news is, as Sunsei continues to grow, they grew 40% last quarter over the prior year quarter, they can continue to have an appetite for more splitters. So when we started talking to them, their internal consumption was going to be around 400,000 splitters, and now it's 750,000 splitters. So if they keep growing, it's a wonderful Trojan horse for us because they're in markets in Europe now. They're entering the North American market, and with the base of business they have in China, it gives us a big leg up on anybody else in that space.
And would their demand run the full gamut of the 1x4s to the 164s?
Yes. Yep. But a lot of 1x32s.
Okay. Moving on to the PLCs, it looks like some of the production's moving over to Fremont from Ottawa. I believe there was contemplation of getting the PLCs into the JV as well. Is that still on the table?
Yes.
And is there a rough timetable in terms of what you're thinking?
Over the summer, but, the May-June time frame to have the equipment operational.
Okay. And any thought to what you could share with regards to capacity in terms of what you'd like to see on the first line?
We're really not there yet. We're in the process of moving it out of the design phase into the production phase. So, we think we're going to have a lot of capacity in that plant when we get the yields up because, again, we've got some government help the JV has in getting equipment, and it's capitalized to the degree and will generate a cash to the degree that we should be able to put more capital into it and expand our capacity as we move forward.
Okay. Moving on to the gross margins, suggested that the gross margin was negatively impacted by 28 points due to lower volume. If we were to back that out, assuming that gross margins should have been 30%, what kind of revenue run rate did you assume to get to that type of gross margin?
To get up to 30.
Sorry, because when I compare it to last quarter, for instance, for the September ended quarter, just under $6 million in revenues, and you had 25% gross margins. So but what would you need on a quarterly run rate to get to the 30% gross margin range?
We would need north of $6 million. It does depend on mix a little bit, Daniel. So between $6 and $7 million, we should be able to get back up to the 30% mark. The new products, as they mature, will help get that up higher without needing incremental revenue.
And obviously, building the Tosa Rosa products over time in the joint venture will assist the gross margin.
Right. And I would presume then, given your AWG VMUX, I presume that's where primarily the pricing pressure is coming in. You anticipate that'll spill over to current March quarter as well?
Yeah.
Yeah, that market right now is under severe pressure. You know, we've seen it in our competition, and you know, the pricing is pretty brutal, and that's one of the drivers of moving into a more proprietary product set.
Thanks. The MD&A did a good job of, this will be the last question, did a great job of highlighting all the new products that will be coming out, and you suggested a rough time frame for some of them. But Tim, could you perhaps highlight either the biggest new product potential rollout or something that would come sooner rather than later in terms of helping revenues get a boost?
Yeah, just a minute, because I'm going to get one of the acronyms wrong. We have a 40 gig DQ PSK product that's going to come out over the summer. This is a product that we designed in Ottawa, and we don't have any restrictions of selling it to anybody. Apparently, although some people are moving to 100 gig, the 40 gig market in China particularly continues to be robust and should be for several years. So that's a real potential driver. We have another product in the I'll call it the Homeland Security space that we're selling prototypes right now. If the end user demand increases like we think it could, that could be a big winner. The multicast switch product that we've started to sell now has some upside, pretty good upside potential. The Tosa Rosa products, the volumes we're speaking of I think we said $5 million. Those are the commitments we have from the people that we did the design work for, but they were the base commitments. You know, that's the minimum they have to buy to maintain their 1-year exclusivity. We're hopeful that the revenue could be significantly higher than that. So that's just a sampling of them. Again, one of the most profitable parts of the whole enterprise at this point, just because of the dynamics of it, is the joint venture, and we're very focused with them on getting that up to full production. Because there's some blue sky upside on what we do for revenue there, I think, long term.
Great. Last question, and I'll get off the call. ASPs, has there been any impact on the splitter business? And wondering if you can give us a range of what you're looking at today. No,
I mean, we obviously have a good handle on the market, but I think a blended price is probably in the low 20s. Again, obviously much different for a 1x4 than a 1x64, but kind of a blended market price is in the low 20s. Some of it will depend over time on, obviously we're selling large volume to our joint venture partner. We'll be selling smaller volume to some other customers, probably at higher prices, because they're not going to get the advantage of buying 700,000 splitters or 800,000 splitters. But the blended price would be in the 20s. One of the questions we're trying to answer right now is, do we want to go into package splitters, which gets you up the curve in terms of the top-line revenue from just selling bare wafers, which we would be selling today, and broadens the market opportunity in terms of who you'd be selling them to. But at, at 1.5 million or 2 million splitters a year, I mean, you're probably close to, if not the leader in that space.
Right. And what would the delta be, Tim, between just a regular splitter off a wafer versus a fully packaged splitter?
Well, Teledata was going to buy some in the last 6 months for $125. So, I think the packaging, not dissimilar to our photodiode business, the packaging sometimes adds quite a bit of margin.
Excellent. Thank you very much.
Okay, thank you.
Thank you. Once again, please press star 1 for any questions or comments.
Okay.
We have no further questions at this time. I would now like to return the meeting over to Mr. Thorstensen.
All right. Well, I appreciate your time. We're obviously in a very difficult transition for this business. We're optimistic that in the last turnarounds I've been involved in, it's always been product that leads companies out of their business problems. The market doesn't usually rescue you, and certainly in this case, it's been our enemy and not our friend. But we have a lot of good technology in this company, and are bringing a lot of it to bear, and have it focused on some rapidly growing markets with our friends and partners in China. So we are hopeful that after this tough quarter, we'll start to see the business improve and get it to a profitable, growing state in the not too distant future. So thank you.
Thank you. The conference has now ended. Please disconnect your lines at this time, and we thank you for your participation.